Podcast is now starting. All attendees are in listen-only mode.
Well, hello there, everybody. This is AJ with Trading Trainer, and I am here for another one of our Ask AJ calls. These are calls that I do roughly about once a month, where I answer the hottest, most burning questions coming my way from my public here, and we do our best to answer the ones that people are asking the most. Now, before we get started, I just want to remind you about a couple of different things. I'm going to start by sharing my screen, and I'm going to bring over a browser window. The first thing I want to remind you is that you came to a page called askajonline.com. And it looks something like this in order to be part of today's webinar. When we have the replay posted, we're going to send you a link by email where you can get the replay. And so you'll notice I've gone to that link, and you can actually get the replays for even the first 3 of these calls, number 1, number 2, and number 3. And we'll have number 4, which is this call, available as soon as we can. Usually it takes about a little less than 24 hours. So we'll do our best to get the replay posted within 24 hours. So I wanted to give you a heads up. Look out in your email for the reminder email that the replay is ready. And yeah. And if you want to get emailed about the upcoming calls, simply give us your name and email address and submit here, and we'll let you know when we have the next Ask AJ webinars coming. Now, I also like to make sure that these webinars are interactive. That means that I get an idea that you're understanding what I'm saying. So one of the ways I can do that is by seeing you raise your hand. So if you will, for those of you that aren't familiar with this webinar software, take a look at where we've got the orange button with the white arrow, and that should be visible even if you're using a tablet or iPhone. And below that orange button with the white arrow, you'll notice a handful of buttons. The button at the bottom of that vertical array is a hand raising button. Will you just show me that you know how to raise your hand by clicking that button right now? Excellent. So what I've got on my side is a list of all of your names as if you're sitting in front of me in a virtual classroom. And I can tell when your hand is up, like Gary's hand is up right now. And if you click the button again, your hand goes back down. Exactly. So sometimes I like to ask you if you're getting it or if you're not getting it, and if you would, please raise your hand and all of that good stuff, just to make sure that there's some comprehension going on with the answers I'm giving you. So understand that button. The other button I would recommend is just clicking that orange button with the white arrow on it. That'll make the webinar control panel squeeze off your screen and just leave behind that compacted vertical array of buttons, that compacted version of the webinar control panel. You really don't need the rest of the control panel. In fact, the designers of this software, in all their brilliance, they made one mistake, which was they didn't think about us investors and traders, right? They made it so that their software shows up in the upper right-hand corner of the screen and covers anything behind it. And that's the business end of our charts. So my recommendation is click that orange button with the white arrow on it, squeeze that webinar control panel off of your screen, revealing all that valuable screen real estate underneath, and then let's get to it. The other thing you might consider doing, by the way, is over here at the top of the Ask AJ Brown page where you are right now, where I am right now if you're looking at my screen. there's a link to Trading Trainer right here in the menu. You can see I'm touching it right now. So I'm going to go ahead and click that link. That brings you to our main Trading Trainer website. And if you are so inclined, I have a little bit of a nerdy streak to me. And one of the things that, if I click through these carousel pictures, there's one of the carousel pictures that says white papers. You can see that right here. And you can click on this button and it gives you a process to go and get these white papers. Basically, you create for yourself a free account on our web portal and you'll have access to these white papers. If you're nerdy like me and you want to read about some of these white papers, go ahead and get a free account with us and we'll give you an access to those white papers and you can log in and read them at your heart's content. Sound like a fair trade? How many with the show of hands say, yeah, that's good? It's not really a trade, it's me just giving you stuff. So again, if you're on the Ask AJ, askaj.tradingtrainer.com, you can click over to the Trading Trainer, or you could just go to Trading Trainer. That's TradingTrainer.com, and then you can click on the white papers and get yourself. It'll give you instructions on how to get a free account in order to get those free white papers. I'd love to share them. I always like to get comments on them and things like that. So let's get right to it. We've got quite a interesting bunch of questions. And the first question I actually want to start with is one that we got, and we actually got different forms of it. It says, what is the easiest option method for beginners? I'm going to bring over a software platform into the view of your camera there called Thinkorswim. And when you take a look at Thinkorswim, which is a TD Ameritrade platform that specializes in options analysis, and you come over here and you maybe take a look at the analyze and the add simulated trades, and you look over here and you put in, for instance, a ticker. I'll just use Apple for lack of a better ticker. What you notice is that there's countless strategies on that you could be trading on against an optionable underlying symbol. And so which one is best for beginners? My personal opinion on this is there is no easiest option strategy to learn. What you're going to have to do is pick an option strategy and learn it inside and out. In fact, I was just going back and forth with someone on who's part of our program, who, in the text messages that they sent me, they were saying, telling me all about their experience with option trading. And so I asked them to show me their actual log of trades. And when I saw the logs, I mean, data doesn't lie. What I saw was beginning trading. And so my knee-jerk reaction or answer to what is the easiest option method for beginners is they're either all easy or all hard. The answer is to pick one and master it. And let me give you a kind of a corollary to that, and that is instead of focusing on a particular strategy, like for instance, vertical spreads is a particular option strategy, let's focus more on a mechanism in which options profit. Because in some cases, you may want to use, option strategies have companions, not just companions, but they have counterparts. And if you're, for instance, focusing on selling theta decay optimized option premium, which is one type of way to profit on options, there's, gosh, a whole handful of strategies that are all very similar. Some of them work in some circumstances, others work in another circumstance. And so that's kind of a better bet, in my humble opinion, is instead of focusing on, for instance, a single option strategy, how about focusing on a single profit mechanism? So the main ones that people focus on is the movement of the underlying symbol. So you can profit on options based on what the underlying symbol is doing. You can profit on options based on changes in something called the implied volatility. Or you can profit on options based on time passing by. Those are all valid ways to profit from options. So I recommend you start by picking one of those, a mechanism or method in which the options, have risk and reward, and learn how to optimize options for that set of variable changes. And that's going to be a lot more helpful for you than, for instance, trying to learn all of options all at once. And on the flip side of that, trying to learn only a single option strategy. Let's move on to the next question. And the next question is, um, is it no, I don't like that one. Um, what is the best strategy to build a profitable trading account starting with a minimal initial capital? That's interesting. That's an interesting question. What is the best strategy to build a profitable trading account starting with a minimal initial capital, with minimal initial capital? What is, by the way, the definition of investing? Does anybody know? If you know the definition or have a definition of yourself of investing, raise your hand. Raise your virtual hand. Okay, I'm going to put your hands down. How do you show of hands when I say, you know, what's the thought? What's your thought about investing? You're really not, that's kind of a fuzzy term for you. Raise your hand. So different than being, this comes from, I guess the guy that really brought it down to like a fourth grade level for us would be Robert Kiyosaki in his book, The Cash Flow Quadrant, which was, I guess, the second in his series around the Rich Dad, Poor Dad. He talked about 4 different ways of money making. One being an employee. An employee exchanges their time on this planet for money. And then the second grouping he defined was being self-employed, which is very similar to being an employee, but you actually are being paid basically on a percentage of product or service sold. But it's you're responsible, and that's self-employed versus employee, but it still comes down to you're trading your time for money. Then there's this third category called being a business owner. And it's interesting, a lot of people who are self-employed, think they're business owners, but the real differentiation is if you walk away from your business, say for instance you take a month-long holiday, if you come back and your business has either stalled or shrunk because you went away, then it's not a business, it's being self-employed. A business owner walks away from their business and it continues to grow, right? A business owner can take a month-long holiday, and when they come back, their business is even bigger than when they left it. A business owner knows how to use human capital and also invested capital in machines to build something, not just a product, but also the marketing and sales, build it so that it keeps growing, right? In other words, they're using human capital to make money. That's a business owner. They know how to manage human capital. Whereas a self-employed person, they are the business, right? If they walk away or if they die, the business dies. Does that make sense? How many to show of hands that makes sense? And then the fourth category that Robert defined was being an investor. An investor is similar to a business owner, but they manage their money, and it's the money that makes money on their money, right? And an investment is where you make money on your money. So there's no really getting around. If you're going to be investing, you need money to invest. So when I read a question, how do I make the most money with the minimal initial capital? How many of you with a show of hands find that there's a contradiction in that question? I find a contradiction. So, there's a scoop, and I'm going to pull out my marker here. When you have an invested dollar, you can put that invested dollar into a risk-free bank account and you'll earn a certain percentage ratio, and there's pretty much zero risk in that. You just put your money in there and it grows by this risk-free amount. And then as your appetite for risk grows, so do the potential returns. So with that said, if your appetite for risk is incredibly high, well, then the potential for returns that you can have is incredibly high. And perhaps that's what this person is getting at. Now, some people don't want to expose themselves to that amount of risk. Now, what are the hedges against risk? I mean, every day you and I, well, most of us, get behind the wheel of a car. There is an incredible amount of risk in driving an automobile, and yet we all do it. So what are the hedges? Well, there's two hedges. One is technology. Cars today almost can drive themselves. Many of the late model cars you buy will actually swerve themselves out of fear's way, or if they see a pedestrian crossing the street in front of you, they'll brake because they're faster than humans are. So there's that. There's using technology. But then the other thing is just through learning and knowledge and ultimately experience, which comes from repeating the same task over and over, that makes it possible for us to remove risk. And if, for instance, when I'm down at my beach house in Myrtle Beach, South Carolina, they don't know anything about snow. So once in a blue moon, when it snows down there, all hell breaks loose on the road. Why? Because people have no experience driving in those conditions. Whereas when I'm at my home in Fort Collins, Colorado, where it snows all the time, everybody's very comfortable driving in the snow. So it's becoming experienced and actually repeating over and over under the conditions that you're experienced in. So with that said, the best way to build a profitable trading account, starting with minimal initial capital, is going to be, and this actually links to our first question, and I'll do that in a moment, but it's picking a strategy and paper trading it until you have the experience where you're very successful with it, and then applying it to your minimal account. But knowing that if you have a small account, no matter what your returns are, they're going to be small because it's all a percentage of your account. Small account gets small returns. Now, the beautiful part is if you don't spend those returns, but rather invest those the next time around and keep, it's called compounding. Okay, so sorry I don't have, sometimes I feel like when somebody asks me those questions, they're looking for some sort of panacea, some sort of get rich quick scheme. And honestly, I don't have it. There's no such thing as getting rich quick, but there is such thing as learning a new skill like trading and going forth with it in order to make profits. So I'm going to jot down, this was question number 2. We're going to jot down these questions so that we keep track of them. So this was question number 2. And question number 1 was, what is the easiest option method for beginners? Now, I got a whole quantity of questions regarding risk. So let's talk about risk. And let's see. What percentage? Um, Here it is. There's a couple questions, but this is the one that's most. This is question number 3. Risk management, how to manage risk money when trading different option strategies. And I'm glad that this question was asked. The corollary to this question is this one. What percentage of your account do you typically put at risk for each trade you place, and what is the maximum percentage of your account that you would allow to be at risk at any one time across multiple trades? So risk management, just as an overview, is one of the most important things a investor must learn. And it comes down to this formula here. The max allowable risk to your portfolio is equal to the max risk in a particular position times the position size, right? So let me first define this. Max allowable risk to your portfolio. Over all these years, so I have been a trader for 22 years now, and I have been teaching trading for just over 16 years. What I have found for max allowable risk to your portfolio is that if your portfolio is less than $5,000, your max allowable risk to your portfolio should be 4%. In other words, no one trade, no one investment position should be able to knock your portfolio down by any more than 4%. Said another way, you would have to do 25 trades in a row, all of them going horribly wrong and tripping your circuit breaker to get the max allowable risk to your portfolio of 4% in order to wipe yourself out, right? I just was, again, talking with a client of mine, a different client than the one I mentioned earlier, who is currently down $35,000 in a trade. It's a very large portion of their portfolio, much more than 4%. This is a trade that this client put on before coming to me to become my client. And that's a very difficult situation to get out of. And this is where risk management wouldn't have let you get into that situation in the first place, right? If you're less than 5,000, max allowable risk to the portfolio of 4%. If your portfolio is $5,000 to $25,000, I have found that your portfolio max allowable risk to the portfolio is nice if it's set at 3%. And going further, if your portfolio is between 25,000 and $250,000, you drop that number to 2%. And finally, if your portfolio is greater than $250,000, sorry about that. Got to show this correctly. Then your max allowable risk to your portfolio should not be any more than 1%. So as your portfolio gets larger, what I'm showing here is that your risk appetite gets less. Never, as a rule, should you ever put more than 4% of your portfolio at risk. Okay, so that explains the number for this. What about the max risk in a particular position? That is a number you should be able to calculate before you even open the position. In your planning, you should place circuit breakers into your position that would knock you out into all cash. So for instance, if it's a directional position, let's just pull up a directional stock or a chart of any kind. So here's a chart on Geo. And so Geo basically has a level of support at about $14.50. If that thing, so you would, for instance, say to yourself, okay, if this gets all the way down to $14, which is a number I haven't seen, in over 6 months, if it doesn't reverse and go up at $14, my conditional trading, my stop loss orders, whatever you use, will knock you out into all cash. So now that you've set what we call a bailout threshold, and in this case I'm using price, but I could also use implied volatility thresholds, whatever threshold you want to create for yourself a plan around what the worst case scenario would be when you get knocked out into all cash. And you want to put in hard and fast trading rules that will automatically pop when those criteria are met so that you are immediately liquidated into an all cash position. And you want to understand that if you put those circuit breakers, not if, but when you put those circuit breakers called our bailout strategies in place and they pop, what is the worst amount of risk? So in a simple long stock position, if we buy a stock for the current price of $14.48, or no, that's the low, the current price of $14.54, and we get automatically liquidated at $14, that would be a 48-cent loss over a $14.48. I keep going back to that price. It would be a 54-cent loss over a $14.54 investment. And so that would be a 3.7% loss. And you can add in a few pennies here and there for commissions, whatever you want, but you want to create the worst case scenario so you understand how much loss you would be exposing yourself to. So let's say it's 3.7% in this example. So our max risk in a particular position is based on your bailout thresholds and strategy. Calculate the worst case scenario. So in our case, we said 3.7% in this random symbol I just pulled up. So 3.7%, say for instance, our portfolio is $50,000. We would have 2%. So again, coming back to this equation, 2% equals 3.7% times the position size. So using a little bit of what we call algebra, you can solve for position size. Position size is equal to 2% divided by 3.7%, which is what? $54. So they're coming back to the question, how to manage risk money when trading different option strategies. And the second question, which was, what percentage of your account do you typically put at risk? So I think I answered that. And the position size, because the second question, and what is the maximum percentage of your account? If I had a position size, if I had a risk to my trade that was less than 2%, and my max allowable risk to my portfolio was 2%, I'd invest my whole portfolio in that single trade. In other words, position size is a function of your max allowable risk to your portfolio divided by the max risk in a particular position. So it all depends on the max risk in your particular position and the max allowable risk to your portfolio. That determines how much of your portfolio goes in there. So for instance, the GLD trade that my client is in, where he's losing $35,000, when I looked at the trade, I realized that at least, and he hasn't given me all the data just yet, but I realized that his max risk in the particular position was closer to 40%. 40%. So if you do that same equation where you say, okay, 2% divided by 40%, he should only be putting 5% of his portfolio into that one trade. He put 30% of his portfolio. Why? Because he didn't do solid risk management. He should have put only 5% of his portfolio. He put 30% of his portfolio. He didn't do solid risk management. And I asked him why he didn't. And he said he's never heard about it. When I interview successful option traders, which I do all the time, I've been wanting to write a book and compile all my interviews. But what I've been doing all these years is when I find somebody who's actually successful, I interview them to find out if there's any links to all the previous people I've interviewed. Smart, right? How many with the show of hands think that's a smart idea? Because there's common traits among successful option traders. And you know what the most common is? They all manage risk the way I just defined it for you. And as a corollary, the unsuccessful traders that I've met, and I've met so many unsuccessful traders, both experienced and inexperienced, the number one thing that they don't do is manage their risk. So this is how I manage my risk. I first have my max allowable risk to my portfolio. I divide that by the risk that I calculate if I get bailed out in the worst case scenario of my position, and that tells me how much of my portfolio I can invest in that trade. And that's it. It's that simple. So simple, but most people don't do it. Let's take a look at the next question. That's risk management. The next question that we wanted to answer tonight was, it's regarding synthetic equivalencies. We've had a lot of questions about synthetic equivalencies, but here's the question that came in most recently. I'm intrigued with a trade where an out-of-the-money put is sold to cover the cost of buying an out-of-the-money call for the same date. I'm told this is called a synthetic stock. I like the idea of a free trade. I would like a better idea about the downside and where to set stops. I see the broker requirements quite high. What other downsides be? What would the other downsides be? This is a great question. We can talk about this, and then generally we'll talk about synthetic equivalencies to begin with. But let's talk about an option in buying a call and selling a put. So let's start with what stock should we start with? Let's find a stock that is, I'm going to go over here I'm going to log into my learning community web portal. Give me 1 second. This is the members only area for the folks who are into my programs, I should say. And I'm going to log in as myself, and I'm just going to use our screener. This is a screener for our watch list, helps us find the trades to sell, and all that good stuff. And I am going to go, I think that's good enough. And I'm going to find a stock that's just around $100. Let's go with Yum Brands. That's the owner of Kentucky Fried Chicken. That's the owner of Taco Bell. And that's the owner of Pizza Hut, Yum Brands. So here's Yum Brands, right? Right now, just about around $100, right? It's down at $98.11 after taking a dump after the recent earnings. All right. So the question is creating a synthetic position. So what happens, first of all, with the stock? So with the stock, we use this thing called a profit and loss diagram. Along the x-axis is whatever the underlying symbol price is, and along the y-axis is the profit and loss. So if you buy a stock, if I pay $98.11, if it goes up $1 from there, I'll make $1 of profit. Pretty simple, right? And if it goes up $2 from there to $100.11, I'll make $2 of profit, and so on and so forth. And by the way, if I go down $1, it's pretty linear. It's just a perfect 1-to-1 ratio. Stop right there. How many with the show of hands are following? Now, what this ask person is saying is, well, what if I purchase an out-of-the-money call? So an out-of-the-money call looks something like this if you look at its profit and loss. Let me change colors. It looks something like this if you look at the profit and loss diagram. And then what happens if I sell a put against it with the same strike price and same expiration date? And what's neat is these options do have what we call a premium price component at it, but it turns out the premium of this call and this put is almost the same. So when you buy one and sell the other, your premiums cancel out. And so yes, you wind up with a synthetic position. Now, what's interesting is this person who typed the question in said specifically an out of the money option, but guess what? It doesn't matter what strike price you use, just so long as the call and the put have the same strike price. The premiums cancel out and all of that good stuff. So they're saying, but wait, that sounds pretty good. Let's do an example. So if I come over here to my Analyze tab and I pull up Yum, and we'll use the options that expire in December because the options in November are kind of Actually, we'll just use the options that expire. They're going to expire tomorrow. But let's take a look here. So what he's saying is, actually, no, let's use December because it'll make more sense. So here's December. He's saying, why don't I use a $105 call? So if I buy that $105 call, or no, well, we can. If I buy this $105 call, I'm going to wind up spending somewhere between 15 and 20 cents. And let's just say that it's about 18 cents. So if I buy that out of the money call, I'm going to spend 18 cents. Now, if I then sell the same strike price and the same expiration date put, I sell this thing for a lot more. And so I get more than a free stock. So let's do the math. We start by buying to open the Yum Brands $105 December call, and we spend 18 cents. And then we sell back this same thing but in the put for somewhere between $7.10 and $7.75, which is about $7.42. Since we were rounding up on the 18, we'll round up here and say $7.43. So this is a debit to our account. I'm going to show that as a minus because we pay that amount. This will be a credit to our account. And so we actually walk away, and this is what he's talking about. We walk away with with making a credit of $7.25. Okay? And you might say, that sounds great. I mean, that's what he's saying in his question, right? He says, I like the idea of a free trade. But what's the downside? Well, what he's not taking into consideration, I say he, it could be a she, what they are not taking into consideration is this is what we call a naked put. And I don't know why I said call, but that's a put. This is a naked put. And so you'll notice he realized that. I see the broker requirement is quite high. The reason the broker requirement is quite high is because this is a naked put. That means that they will need you to have a margin account in order to do this trade, because if you get exercised, if you have a symbol put to you, you will need to have $105 available to cover that. So when you do this part of the trade right here, your broker will automatically assess you something called a margin requirement of $105. They will actually freeze up $105 of your account. Now, what they'll actually do is they'll free up the credit. They'll take this $7.25 and they say, until you close this position, you're not going to see that credit. And then they'll say, okay, that accounts for $7.25 of the 105 you've just got yourself on the line for, but now we're going to take $97.75 as well. And they're going to freeze that. They're not going to allow you to use that money in your account until you close the position, because they want to make sure that if the position goes against you, you're covered. This was something that is very, very important. And if it was in place during the 1929 stock market crash, a lot of people wouldn't kill themselves, right? So banks have these margin requirements now to protect yourself against yourself. So it's not really a free trade. Yes, you get 725 credit, but you're not going to see it. In fact, when you do this trade, you're going to see $97.75 of your account frozen in a margin requirement, which is actually quite interesting, because if you did the trade the other way, you would see $98.11. Let me get rid of all this chicken scratch. Overall portfolio frozen in margin requirement, we said was $97.75. And how much is the price of the stock? Stock price, $98.11. In other words, there's a 36-cent difference between these two strategies. Now, what happens if the stock goes up $1? Well, this put is less apt to be called out. This call is going to wind up still expiring worthless, but it's going to be gaining some value. In other words, if you actually do the analysis, this is going to move dollar for dollar as well. If this underlying symbol, YUM, moves up $1, then the margin requirement actually reduces by $1, and therefore you get to see $1. Not until the position's closed, but the economics work out for you better. They're exactly the same. They're synthetically equivalent. They have the same amount of upfront cost, whether it's frozen in your account, like in the case of 97.75, or in the stock price. You're going to be losing that amount of money of your account to be used for anything else, whether you buy something or whether the broker freezes it in your account. Does that make sense? How many, with a show of hands, that makes sense? In fact, let's do the same exact thing, but let's go in the other direction. What happens if we decide to use the $90 instead of the 105? We'll do the same thing here. I'm just going to copy and paste and then fill in the blanks. So instead of doing the December 105 call, I'm going to use the December 90 call and the December 90 put. So the December 90 call, we would pay somewhere between $8.15 and $8.35. I can actually do that in my head. We would pay $8.25. And then on the flip side, we would get a credit of between 31 and 35 cents. That would be 33 cents. So you'd get a credit of 33 cents. So in this case, what's our margin requirement? Well, first of all, we would wind up spending how much? $8.25 of debit minus 33 cents of credit $8.25 of debit minus 33 cents of credit is $7.92 of debit. And then the margin requirement would be $90 in addition. So there's a margin required of $90. You didn't make any credit, so they are actually going to freeze up $90 of your account. Plus you had $7.92 of debit. So with this scenario, overall portfolio frozen in margin requirement is $90 plus $7.92 of debit. And that's going to be equaling a total of $97.92, right? And so all three of these have about the same price. Does everybody see that? How many with the show of hands see that? This is just, again, proving I could do this in all day and all night with every strike price and every expiration date, and you will see that they're all within 20 or 30 cents of each other. And that just there's a little bit of uncertainty in the prices, especially end of day prices. But that's how synthetics work. So let's list some of the different synthetics. We just went through in detail stock, long stock equaling long call and shorted put. This is a cash trade. This is a margin trade. This is a cash trade. This overall synthetic equivalent of a long stock is a margin trade because of that shorted put. What about a shorted stock? How many of you with show of hands are familiar with short stocks? This is where instead of buying a stock and making money on it as it appreciates, you sell to open a stock and you make money on it as it depreciates. You can create a synthetic equivalent to that by shorting a call and going long a put. So buying the put and selling back the call. Some other synthetic equivalencies, if you're into vertical spreads, they have this thing called a bull call vertical debit spread. It behaves exactly like a bull put vertical credit spread. Bear put vertical debit spreads equal bear call vertical debit spreads, credit spreads. They're exactly the same. You get the same effect whether you do one or the other. How about a call condor being the same as a put condor being the same as an iron condor? They're all the same. They're all synthetically equivalent. Sometimes they're called synthetics. So you might say, well, why would I do one over the other then, if they're all the same? Well, there's some different thoughts. Some of them, depending on the outcome of the strategy and the pattern, might accrue less commissions. So you might choose one over the other because it has less commissions. You might choose one over the other because you're trading in just a cash account and you don't have a margin account. So cash versus margin, commissions. Some of them expire by going all the way down to zero, and the others expire by going up to, for instance, a spread value. Well, when something goes down to zero, it really can't get past zero. But if something, for instance, goes up to a spread value, there could be, like we see here, a difference of maybe even 5, 10, 20, 25%, 25 cents. And you might be able to take advantage of that arbitrage and get your commissions and your bid-ask spread covered by doing the strategy that expires high versus low. So that's another reason why people might choose one synthetic equivalent over the other. And then a neat strategy I like to do is if I don't care which one, most brokers now are having these smart trading rules that you can apply to your trades, even beyond rules like good for the day or good till canceled. But you can actually have the filling of one position cancel an order for another position. And so what I might often do is if I don't care which synthetic I'm doing, I might say, buy this stock. I'm going to put a limit order out to buy this stock for, say, $97.50. I'll put that limit order out and I'll make it good for the day. At the same time, I'll put this order out and I'll put this order out, say, for this one, and I'll say, make sure my debit is not more than $7.50, knowing that if that order fills, I'll have a margin requirement of $90. Now, both of these are below what's currently available, and one of them might fill faster than the other or at all compared to the other. In other words, I'm giving the traders down on the options floor and on the stock floor, which are now electronic, I understand, but they're giving them the ability, more flexibility to fill my order in different ways. And so because I don't care which way the order fills, just that it does fill at the price that I want, I've now opened myself to getting my order filled a little bit better. Do people understand that? If you understand that, raise your hand. It's a very powerful strategy that I'm sharing with you. In fact, say for instance, this one, your bank comes along with that margin requirement, might charge you a point or two. And so sure, to account for that, you might say, if this one gets filled, I want it to go for $7.48 of debit, whereas this one I'll take $97.50. And you can build in, or if one's going to get charged commissions, more commissions than the other, just change the price for that particular strategy to accommodate that, and then let it run. Now you've got two different ways to get the same thing accomplished, and you're allowing the traders more flexibility to fill your position. How many with a show of hands see how valuable that might be? It's incredibly powerful. Say, for instance, you go out there with a bull call vertical debit spread and you say, I want it to be filled at a better price. My limit order for that is going to be $3.50 on a $5 spread. And you say, I don't want to pay more than $3.50. Well, simultaneously, you can say, or fill this same exact synthetically equivalent credit spread and give me a credit of $1.50, knowing that my margin requirement will be $5, so it'll wind up being a margin requirement of $3.50. So I'll put it out there that I want to get the bull put vertical credit spread a credit of $1.50, or I'll take the bull call vertical debit spread for a price of $3.50, and whichever one fills first it doesn't matter because it's the same synthetic output for me. And now I'm giving the traders two different ways. And I'll make it so that if this order fills, this order automatically cancels and vice versa. And so I'll come back at the end of the day with a higher probability of seeing my position filled the way I want it to. Does that make sense? How many at the show of hands that makes sense? How many of you with a show of hands who have any sort of options experience have in the past found yourself saying, well, I only want to do credit spreads. I don't want to do debit spreads. Because I've talked to so many traders in the past who are like, I don't want to even talk about debit spreads. I'm only doing credit spreads. And now I hope you understand, now that you understand more about synthetic equivalencies, how naive you might be. You're missing an opportunity to be able to get your position filled, right? Because they're exactly the same. They behave exactly the same way. And so why not put it out there to let the first available one at the price you're willing to pay get filled? It doesn't really matter. You see? Very powerful. So I hope you picked up something along the way here on these questions. Let's see if we answered that one. I'm right at the end of my hour. In fact, I've gone over, so I want to let you guys go. But I see the broker requirements are quite high. That's the main thing you need to know, is that you'll need a margin account for this. And you'll probably, depending on the broker you're with, need to sign some papers and show, in some cases, some of the older brokers like the Fidelities and the Schwabs will want you to prove that you have the ability, the experience to be able to trade these type of strategies. Some of the newer brokers that are options focused won't ask for that, but you know, the downside is you need to have the knowledge, like we talked about in the beginning of this call. If you're going to do this kind of stuff, you want to have the experience to do it. But once you have the experience, just like once you know how to drive the car, it's no longer a big deal. Once you understand synthetics, it's no big deal. You realize that now you've just opened up the door to really be able to tune your position exactly the way you want to do it down to the penny, or open up the ability to get your position filled at the price you want to and allow the flexibility to the traders so you're more likely to get filled. So the downside is you need experience as well as knowledge. You need to have a margin account, and you need to have the fulfillment that your broker requires to do these different types of trades. All right, so we hit a few questions this evening, but we did some deep dives on some powerful ones. How many of you, with a show of hands, picked up something new you did not know before? Oh, wow, that's great. I appreciate that. How many with a show of hands, you picked up something new or not new, but now you have a much better idea how to wrap your head around a topic? Excellent. How many with a show of hands just plain old enjoyed yourself this evening? Excellent. And probably the most important thing is that I take one more time and show you, please, when you get notified, or you can go there now, askaj.tradingtrainer.com. You'll get notified when the replay is ready. So if you have questions about this evening, you can go back and watch the replay. And also take a moment and visit my main site and get yourself free access to my white papers and enjoy nerding out on those. Till next time, which will probably be in the month of December, I hope you all have a good rest of your evening, and please enjoy what you took away this evening. Thanks, everybody. Bye.